Most people think the money in their retirement account can only be invested in stocks and mutual funds, but with a self-directed IRA and a Checkbook LLC, that money can actually be used to buy real estate that generates passive income. In this video, I'll explain how the structure works and how property managers can automate the investment so it runs with minimal involvement. A self-directed IRA works almost exactly like a normal IRA in terms of tax treatment. You still get the same tax advantages depending on whether the account is a traditional or Roth. The difference is what you're allowed to invest in. Most brokerage IRAs limit you to traditional financial assets like stocks, bonds, mutual funds, and ETFs. A self-directed IRA expands those options significantly and allows investors to purchase what the IRS calls alternative assets. These can include things like real estate, private lending, tax liens, private equity investments, and even certain types of startups. The structure still requires a custodian because retirement accounts must legally be administered by an approved financial institution, but instead of restricting investments to Wall Street products, self-directed custodians allow the account to invest in alternative assets. Real estate is one of the most common uses of a self-directed IRA because it provides something many investors want: predictable income and tangible assets. Instead of hoping your retirement account grows based on market fluctuations, you can own rental property that generates monthly income. However, there is one practical challenge with self-directed IRAs. Every time the account wants to make an investment, pay an expense, or move money, it usually has to go through the custodian for approval and processing. That can slow things down significantly, especially when you're trying to act quickly on a real estate deal. This is where the Checkbook LLC structure becomes important because it gives the investor much more direct control over the investment process. A Checkbook LLC is simply a structure that gives your retirement account more control over how investments are made. Here's the basic idea. Your self-directed IRA becomes the owner of an LLC. The LLC is created specifically for the retirement account, then the money from the IRA is transferred into the LLC's bank account. Now, instead of asking the custodian to approve every transaction, the LLC can directly make investments. That's where the term checkbook control comes from. The LLC has its own bank account, which means when an investment opportunity appears, the LLC can send the funds immediately. For real estate investors, this can make a big difference. Imagine you find rental property priced at $200,000. If your retirement account is structured with a Checkbook LLC, the LLC can directly purchase the property. The title would show the LLC as the buyer, and the retirement account remains the owner of that LLC. From that point forward, all income and expenses related to the property flow through the LLC's bank account. Rent payments go into the LLC, repairs, taxes, insurance, and maintenance are paid from the LLC. The structure allows the retirement account to own the real estate while maintaining the tax advantages of an IRA. More importantly, it allows investors to act quickly when opportunities appear instead of waiting days or weeks for custodial approval. Once the IRA and the Checkbook LLC have been set up, the actual process of buying real estate becomes surprisingly straightforward. For example, imagine you have $250,000 sitting in an old 401k from a previous employer. Instead of leaving that money in mutual funds, you decide to roll it over into a self-directed IRA. Step 1 is opening the self-directed IRA with a custodian that allows alternative investments. Once the account is open, the retirement funds are rolled over into the new IRA. Step 2 is creating the Checkbook LLC. The IRA becomes the owner of that LLC, and you are typically listed as the manager of the company. After the LLC is formed, the IRA sends the investment funds into the LLC's bank account. Now, the LLC has cash available to invest. Let's say you identify a rental property listed at $200,000. Because the LLC already has funds in its bank account, the purchase can be made directly by the LLC. The purchase contract lists the LLC as the buyer, not you personally. At closing, the LLC wires the funds and becomes the owner of the property. From that point forward, everything related to the investment flows through the LLC. Rental income goes into the LLC's bank account, property taxes, repairs, insurance, and other expenses are paid from that LLC. The remaining profit stays inside the retirement account structure and continues growing tax advantage. Now, this is also the point where it's important to understand the IRS rules around these types of investments. Retirement accounts have strict prohibited transaction rules. For example, you cannot personally live in the property, rent it to close family members, or personally perform certain types of work on the property. Everything has to be handled as a true investment at arm's length. But when the structure is set up correctly, this approach allows retirement funds to directly own income-producing real estate. Once the property is purchased, the goal is simple: generate consistent rental income that flows back into the retirement account. Using the example from earlier, imagine the LLC purchased a rental property for $200,000 in cash. Let's say their property rents for $1,800 a month. That produces $21,600 per year in gross rental income. Now, of course, every property has expenses. You might have property taxes, insurance, occasional maintenance, and property management fees. For a simple estimate, let's say the total expenses average around $700 per month with everything included. That will leave about $1,100 per month in net income. Over the course of a year, that's about $13,200 in rental rental income flowing back into the LLC that is owned by the retirement account. In a traditional IRA, the income grows tax deferred. In a Roth IRA, it could potentially grow tax free depending on the situation. But the real key to making the strategy passive is not just the property itself, it's the use of professional property management. A property management company handles most of the day to day operations of the rental. They typically manage things like tenant screening, lease agreements, rent collection, maintenance coordination, and dealing with tenant issues. Instead of being the person answering phone calls about repairs or late payments, property manager handles those tasks while the property continues generating income. And that's what allows the strategy to function much closer to true passive income. Property manager essentially acts as the operational layer of the investment. Most property management companies charge somewhere between 8 and 12% of the monthly rent, depending on the market and services provided. In return, they handle nearly everything required to keep the property operating. They market the property when it becomes vacant, screen potential clients, run background checks, and prepare lease agreements. Once the property is rented, they collect the monthly rent and deposit the funds. If a maintenance issue comes up, the property manager coordinates the repair with the contractors and handles the communication with the tenant. They also help manage compliance and local rental laws and eviction procedures if necessary. From the investor's perspective, the process becomes much simpler. The tenant pays rent to the property manager deducts the management fee and repair costs, then the remaining funds are sent to the LLC bank account that belongs to the retirement investment. Because the LLC is owned by the IRA, those profits remain inside the retirement account and can either accumulate as cash or eventually be used to purchase additional investments. This structure is what allows many investors to own rental property inside the retirement accounts without needing to actively manage tenants or property operations themselves. While this strategy can be powerful, there are some important rules investors need to understand before using retirement funds for real estate. The biggest one involves prohibited transactions. Because the property is owned by your retirement account, you personally cannot benefit from it directly before retirement. That means you cannot live in the property, rent it to yourself, or rent it to certain close family members like your parents or children. You also generally cannot personally perform work on the property. For example, you shouldn't be renovating the kitchen yourself or fixing plumbing issues. Those services should be performed by independent contractors and paid for by the LLC. Another important rule is that all property expenses must come from the retirement account structure. You cannot pay property expenses out of your personal bank account, and you cannot deposit personal funds into the LLC unless it's structured as an official retirement contribution. Because these rules are strict, many investors work with experienced custodians, attorneys, and tax professionals when setting up this structure. Following the rules correctly is critical to maintaining the tax advantages of the retirement account. Most retirement accounts are heavily tied to the stock market, but they don't have to be. Through a self-directed IRA and a Checkbook LLC, investors can use retirement funds to directly purchase real estate. That property can generate rental income that continues growing inside the retirement account while maintaining the tax advantages of the IRA structure. When professional property managers are used, much of the day-to-day work is handled for you. Tenants, maintenance, rent collection, and operations can all be managed by the property manager while the investment continues producing income. For investors who want more control over how their retirement money is invested, this strategy opens up the door to building long-term wealth through real estate. If you found this video helpful, please consider leaving a like down below and let me know if you want to hear any more investing strategies. Thanks for watching, and I'll see you next time.